Welcome back to the Deep Dive. Today, we are immersing ourselves in the world of, well, high-end, high-volume South Indian ethnic wear. You've provided us with sources from Sai Silks, Kalamandir Ltd, SSKL for short, and we're looking specifically at their pretty explosive performance in the first half of the financial year 25-26.
Yeah, it's quite something.
Our mission today is really to look beyond those impressive headlines and try to unpack the company's multi-format retail strategy. It seems quite ingenious, actually. We need to figure out how they're balancing these, luxury silk saree sales with a more value-focused mass market expansion. And what are the real engines driving this growth, especially in what feels like a really competitive market right now?
Absolutely. And when we talk about growth, it's not just ticking up slightly. We're talking about, an operational masterpiece, seems fair to say. The headline figure here, and the real reason we're spending time on this, it's the bottom line. A massive 171% increase in half-year profit after tax, or PAT. That kind of jump, that kind of acceleration, it just doesn't happen by accident. It really signals a major strategic shift, I think, not just, a good quarter.
Okay, let's definitely unpack this now. We should start with the scorecard, look at that phenomenal acceleration first. So looking first at the financial health check for you, the listener. In quarter two alone, revenue was up 28% year over year. That hit about 444.33 crores.
Pretty solid.
But the profit really took off. PAT jumped by nearly 69%, 68.59% to be exact, landing at 40.08 crores.
Wow.
And then when you zoom out to the half-year performance, the overall revenue rose 34% to 823.35 crores. And that profit after tax, well, it soared to 70.14 crores. That's the 171% jump.
It's really important to understand the demand side that fueled this. Management was quite quick to note they benefited quite a bit from a highly favorable wedding calendar and the early onset of festivities this year. This translated directly into, higher ticket size purchases, especially within the categories where SSKL really excels. Wedding wear and that high-end occasion wear.
Right, their sweet spot. And crucially, that consumer demand flowed right into their established physical stores. We're looking at what the industry calls SSG, same-store sales growth, which is basically the health check of their existing shops, right?
Exactly. It tells you if the core business is healthy.
And Q2 SSG stood at a powerful 17.5%. The half-year SSG was even higher at 21.5%. And they're basing that velocity on 50 qualifying stores.
Yeah, that SSG figure, that's the real confidence indicator here. If your existing footprint is generating 21.5% growth, your expansion plans aren't just about opening empty boxes.
Right.
They're opening productive revenue streams. And this has led management to immediately boost their expectations for the full year. Their initial annual growth target was, I think, around 15%.
Yeah, 15%.
They've now raised that guidance to anywhere between 18% and 20% for the full year. They're projecting a revenue of approximately 925 crores just for the second half, H2.
Wow, that kind of pressure means they have to be executing a brilliant strategy on the ground, which I guess brings us to how they're building the infrastructure to match that new ambition. Let's look at their multi-format strategy.
Exactly. Their current footprint is 74 stores across 22 cities and 4 states. They manage about 7.5 lakh square feet of retail area, but crucially, they don't use a one-size-fits-all model.
No.
They run 4 main existing formats. You've got Kalamandir and Mandir, which are more traditional styles.
Okay.
Then there's KLM Fashion Mall, that's designed as their sort of family value brand, offering broader categories like kids wear, even some Western wear.
Right, the broader appeal one.
And then the powerhouse, Mahalakshmi Silks, or VML, that's their high-end, premium, silk-focused engine. Currently 36 stores.
And VML has really been the engine driving recent growth, hasn't it? They're aiming for some top-tier productivity numbers there. 45,000 to 50,000 revenue per square foot is the target.
That's the goal, yeah. Very ambitious.
They've improved recent performance to approximately 35,000 per square foot on that expanded capacity. But the question is, how do you maintain that kind of growth when the premium market maybe starts to get a bit saturated?
Here's where it gets really interesting. They aren't just banking solely on VML maturity. The big strategic pivot seems to be the introduction of this 5th format, Valley Silks.
Valley Silks. Okay.
This is a dedicated strategic move, launched in 2025, and they already have 7 stores running 4 brand new. 3 were conversions from other formats.
So what makes Valley worth the management focus and the risk? How is it different from KLM, their existing value segment?
Valley is, it's an entirely different beast, as they say. It's explicitly designed to be a digital-first shopping experience.
Digital first. Okay, what does that mean in practice?
It means that they're targeting the modern, often younger, price-sensitive consumer who probably starts their shopping journey online, browsing Instagram, looking at websites.
Right.
So Vali isn't built primarily around just hoping people walk in off the street. It's built to convert that digital discovery into a quick, low-friction store visit. The physical store is almost like the final touch point, the collection point perhaps, not the initial discovery engine.
That makes a lot of sense, actually. The product focus seems to reflect that model, too, doesn't it?
It does, absolutely. Vali focuses heavily on low-priced ethnic wear. It's concentrating on powerloom categories, entry-level silk saris. The critical differentiator is price.
How low are we talking?
The majority of offerings in Vali are priced less than €4,000. It's high-volume, accessible pricing. Very different from the high-ticket VML experience.
Okay, that sounds like a potentially brilliant expansion strategy for just getting market penetration, getting the brand out there in a new segment. But expansion always requires serious capital. Is that where the operational advantage of Vali comes in? Is that the key?
Absolutely. The unit economics are radically different from VML. Valley stores are quick to deploy. They reckon they can open one in just 20 to 25 days.
That's fast.
And get this, they require 20-25% less capital expenditure, less CapEx compared to setting up a VML store. They're also much smaller, averaging around 3,000 to 3,000 to 3,500 square feet.
So speed and lower cost.
Exactly. That combination makes Valley a potentially disruptive format if they can scale it effectively.
But hang on, if Valley is focused on high volume, probably needing discounts to move that volume in a tough market, isn't that potentially going to dilute the overall margin success they're having with the premium VML brand?
That's the key strategic trade-off, isn't it? Management is quite clear about this. Valley currently demands a comparatively lower margin than the other formats, no question.
Okay.
However, they seem willing to accept that trade-off right now. The goal is deep brand penetration, rapid expansion into these untapped price segments. It looks like market share and footprint first, margin optimization later.
And they're pursuing both tracks.
Yes. The plan for the second half of this year includes opening 5 to 6 new Valley stores and 3 to 4 more VML stores. It shows that dual focus quite clearly.
That strategic tension, sacrificing margin for penetration, the classic retail move, but risky.
Yeah.
Let's zoom in on the mechanics now.
Right.
Specifically, the operational efficiencies that let them handle such rapid expansion without costs just spiraling out of control.
Right. So on the gross margin front, they are intentionally maintaining them around 42%, plus or minus maybe 0.5%. The strategy right now isn't really to squeeze margins higher.
Oh, interesting. Why not?
They want to achieve optimal productivity first, especially in those VML stores that have recently expanded capacity. Get the stores running at full steam before trying to push margins higher. They believe maximizing store utilization comes first, then margin expansion.
That's disciplined. And the most, frankly, shocking operational detail we found was their real estate strategy. Their rent structure seems like a critical success factor. SSKL maintains a low rent-to-revenue ratio of just 4%.
Yeah, that's incredibly low.
Compared to an industry typical of maybe 8% or even 9%, that feels like a massive operational, cheat code almost.
It really creates incredible stability and resilience for them. They achieve this advantage partly through consistently higher store productivity, meaning they earn more per square foot to cover the rent, and partly by locking in very long-term lease negotiations. We're talking typically 9 to 15 years, and often with only a 15% rent increase every 3 years. That predictability just insulates them from real estate market volatility. Is huge.
Definitely a competitive edge. Okay, shifting focus a bit to inventory. We did see a spike in trade payables and inventory in the financials for Q2. Does that signal potential risk, or is it just cyclical timing?
It seems cyclical and expected. Management explained this was really due to massive forward buying in Q2. They had to stock up heavily to prepare for major festivals like Dasara, Diwali, and of course the massive upcoming wedding season, which dominates Q3 and Q4.
So just loading up for expected demand.
Exactly. High stock purchases necessitated by the sales calendar.
Okay. And one of the biggest operational differentiators for a sari retailer versus, say, a standard ready-to-wear apparel retailer is inventory aging, isn't it? That one-size-fits-all nature of the sari must be a huge operational advantage.
It really, really is. They completely avoid the seasonal markdown headache that basically every ready-to-wear retailer deals with constantly.
Right.
According to them, only about 10% to 12% of their total inventory is over 1 year old, which is fantastic.
That's very low.
Yeah. Because they don't deal with multiple sizes and rapidly shifting fashion cuts, they don't have to write off stock nearly as often. They manage it actively rotating stock between their different formats, maybe using internal sales incentives. It keeps that aged stock monetizable, preventing that sort of markdown apocalypse you see elsewhere.
Okay, now let's circle back quickly to Valai and this digital-first concept. It sounds like the entire business is evolving into more of a truly omni-channel play, driving traffic from screens into physical stores.
Absolutely. It seems digital discovery is driving footfall across the board now, not just for Valley. The goal seems to be a unified shopping experience, from social media right through to the store.
And is this focus helping older formats, too?
It seems so. The KLM Fashion Mall, their family value brand, is apparently seeing its second consecutive good quarter of same-store sales growth.
Oh, interesting.
Yeah, supported by changes they're making in product mix and also some new store display initiatives they're piloting in, I think, 4 or 5 locations.
So adapting across the board.
Right. And while they definitely acknowledge there's increased competition from new digital-only players, other organized giants, and the unorganized sector is always there. SSKL seems to be relying heavily on deep brand loyalty and customer trust to withstand those market disruptions.
Makes sense. Let's pivot then to the final look ahead, future product focus, and the overall speed of expansion. Where are they going next with products?
Product diversification remains highly disciplined, it seems. The primary focus is definitely still the women's wear segment. They correctly note it's about 5 times larger than the men's segment in India.
Right.
So the most likely area for diversification soon is probably the women's ready-made category, specifically Kurtas and Curtis. They'll likely leverage their existing in-house label Dakara for that.
What about menswear or kidswear?
Beyond what they already offer in the KLM formats, expanding significantly into menswear or kidswear is simply not a priority right now, according to management. Focus remains on women's ethnic wear.
Okay, focused. And if they execute this dual strategy flawlessly, maturing VML while rapidly deploying Valleys, what's the long-term payoff they're aiming for?
Management is targeting a profit after tax margin, PT margin, of 8.5% to 9% for the full financial year 27.
So a couple of years out.
Yeah. They expect this improvement to be driven almost entirely by operational efficiencies kicking in, as both the established VML stores and these new Valley stores reach maturity and hit their optimal productivity levels.
Given the rapid expansion planned for Valet, are they considering an asset-light model yet? Maybe franchising Valet to speed things up even more?
Not just yet. Management sounds quite cautious on that front. They explicitly said they want another couple of quarters of solid performance data on the Valet format itself.
Okay, proof of concept first.
Exactly. Before they attempt to build out a really robust franchising or other asset-light model. For now, they seem to prefer controlling the expansion entirely through owned and operated stores. They want to ensure the unit economics are perfectly understood before they risk brand standards by rolling it out wider through partners.
That sounds like a very controlled and deliberate path to expansion. Okay, so to summarize the core takeaway from this deep dive for you, SSKL is executing what looks like a brilliant balancing act. They're aggressively targeting the high-volume value segment through this new capital-efficient Valley format. But simultaneously, they're working hard to mature their premium growth engine, VML, making sure profitability keeps pace with their physical expansion.
Right. And this whole strategy, especially Valet, raises a really important question for you, the listener, to consider as you watch their next moves.
Okay.
The Valet format is explicitly designed for this quick, low-cost expansion. Remember that 20–25% lower capital expenditure requirement we talked about.
Yeah, the key advantage.
If that model really succeeds and scales rapidly, how quickly will SSKL's approach force the rest of the traditional, maybe slower-moving South Indian sari retail market to fundamentally change their own cost structures? How will they compete on pricing if Valet takes off?
Yeah. Will it reset the competitive landscape on cost?
Potentially. It's definitely something for you to think about as you watch how this unfolds.
A perfect thought to chew on. That concludes our deep dive into Sai Silks Kalamandir's impressive operational strategy and their bold Valet pivot. Thank you for diving in with us.